The strategy of buying low and selling high is one of the most fundamental principles in investing, widely endorsed by legendary investors like Warren Buffett, Benjamin Graham, and Peter Lynch. It's a simple yet powerful approach aimed at purchasing assets when their prices are undervalued and selling them when their prices reach fair or overvalued levels. Although this strategy may sound straightforward, implementing it effectively requires both discipline and understanding of market cycles, valuations, and investor psychology. Let's delve into how top investors apply the buy low, sell high strategy and the key principles they follow to succeed. The core principle: value investing. The concept of buying low and selling high is rooted in the philosophy of value investing, a strategy championed by Benjamin Graham, the mentor of Warren Buffett. According to Graham, successful investing involves purchasing stocks when their market price is below their intrinsic value, allowing for a margin of safety. Intrinsic value refers to the true worth of a company, determined by factors such as its earnings, assets, and future growth potential. If an investor buys a stock at a price below this intrinsic value, they set themselves up for a profitable exit when the market corrects and the stock price rises to reflect its true value. Warren Buffett, one of the most prominent adherents of value investing, has repeatedly emphasized the importance of patience and long-term thinking. In his famous shareholder letters and interviews, Buffett highlights that investors should focus on companies with strong fundamentals, predictable earnings, and sustainable competitive advantages, what he calls economic moats. By buying these companies when they are temporarily undervalued, due to market mispricing or temporary setbacks, investors can position themselves for substantial gains over time as the market recognizes the true value of these businesses. Timing and market cycles. The challenge of buying low and selling high lies in the timing. Market cycles are inherently unpredictable, and while a stock may seem undervalued at one point, its price could continue to fall before recovering. Successful investors understand that market downturns often create buying opportunities. However, recognizing these opportunities requires a thorough understanding of market cycles and the psychological behaviors that drive market movements. Peter Lynch, another well-known investor, famously said, "The key to making money in stocks is not to get scared out of them." Lynch's approach was to focus on the long-term potential of companies, particularly those that are temporarily undervalued due to market pessimism or short-term negative news. He used his ability to spot businesses with strong growth prospects and deep understanding of their industries to buy them during dips in stock prices. Lynch's approach underscores the importance of buying on fear, a concept that is often difficult for most investors to execute, as the general tendency is to sell during market downturns out of fear and uncertainty. Top investors like Buffett and Lynch believe that the key to buying low is staying calm during market volatility. Investors must resist the urge to sell in a panic when the market experiences sharp declines. This is when bargains are most abundant, and buying during these times can lead to significant long-term gains. Understanding the concept of value versus growth. While buying low and selling high is commonly associated with value investing, it can also apply to growth investing, albeit with a slightly different approach. Growth investors, such as Philip Fisher and more recently, investors like Cathie Wood of ARK Invest, focus on companies that are expected to experience above-average growth. The difference here is that these investors are often willing to pay a premium for high-growth companies, betting that the future potential of these companies will justify the higher valuation. A challenge with growth investing, however, is distinguishing between real growth potential and speculative hype. Investors who follow the buy low, sell high principle in the context of growth investing need to remain vigilant about market trends and avoid chasing stocks that are overhyped or overpriced due to speculative interest. The dot-com bubble of the late 1990s is a prime example of how speculative buying can drive stock prices far above their intrinsic value, leading to eventual crashes. The key insight here is that growth investors can still buy low if they focus on undervalued growth stocks, companies that are in early stages of growth or have been temporarily overlooked by the market. However, determining when a growth stock is truly undervalued requires an in-depth understanding of the company's long-term potential, including its competitive advantages and industry trends. The role of patience and emotional discipline. One of the greatest challenges in buying low and selling high is overcoming emotional impulses. The market's short-term fluctuations can create emotional reactions that lead to poor decision-making. For example, during market declines, investors often panic and sell their holdings, missing out on potential long-term gains when the market rebounds. Conversely, during market rallies, investors may become overly optimistic, buying stocks at inflated prices and then facing losses when the market corrects. Emotional discipline is essential for long-term investing success. Investors must be able to stick to their strategy, buying when others are fearful and selling when others are greedy, as famously stated by Warren Buffett. This approach requires keeping a clear head and maintaining a long-term perspective, even during periods of market volatility. Emotional control allows investors to take advantage of market inefficiencies and recognize opportunities when stocks are undervalued due to temporary pessimism. The role of market sentiment and contrarian thinking. The concept of contrarian investing is deeply tied to the buy low, sell high strategy. Contrarian investors seek to profit from market sentiment that has swung too far in one direction. When the market is overly optimistic and stocks are overpriced, contrarians will sell or avoid buying, while during periods of excessive pessimism, they will look for undervalued opportunities. This strategy requires the ability to think differently from the crowd and to go against prevailing market sentiment. John Templeton, one of the pioneers of contrarian investing, famously said, "The best time to buy is when there's blood in the streets." Templeton's approach involved purchasing stocks when others were selling in fear, typically during market crashes or times of extreme pessimism. By buying low during such times, he positioned himself to sell high when the market recovered and stock prices rebounded. Technical analysis versus fundamental analysis. While top investors like Buffett and Graham focus on fundamental analysis, which involves evaluating a company's financial health, growth prospects, and intrinsic value, some investors use technical analysis to help them determine when to buy and sell. Technical analysis involves studying stock price patterns and using indicators such as moving averages, relative strength index, RSI, and Bollinger Bands to predict short-term price movements. Though technical analysis can,